It's important to note that when stable economies have high interest rates, the value of their currencies goes up a lot relative to other currencies. And we really need to understand this phenomenon when we analyze companies that are doing business in other countries. Unless that company hedges out their currency exposure, right? Meaning that they buy an insurance finance product that protects the currency they're exposed to if it goes down a lot. And we'll cover the concept of making money when stocks go down, meaning shorting securities later in the course. But what happens is you can actually make money or protect yourself by buying financial instruments that are profitable if a certain commodity or stock, etc., goes down a lot. And before I go on, let me quickly talk about Southwest. Southwest is a juggernaut of an airline, a big airline here in the United States. Okay. And they put almost all their competitors out of business, right? Last decade. And the way they did that was, around 2001, 2002, they bought a ton of forward contracts on the price of oil, a hedge. So if the price of oil went up a lot, right, they made money. But they set it up in such a way that they are protected if prices were very volatile. And when prices went up materially for the price of oil, when oil was like $100 a barrel, right? What Southwest did was, because they had exposed themselves in a hedging way so that oil only cost them $30 a barrel, they cut prices aggressively. And it was very predatory, and they almost put some of their competitors into bankruptcy. Okay, well, again, we'll talk about hedging a little bit later, but I wanted to put that on your dashboard. Okay, so let's move on. So generally speaking, the United States dollar strengthens when the U.S. government raises interest rates or when other countries see the U.S. as a relative flight to quality in times of extreme economic uncertainty. Okay, and a great website, for understanding not just currency rates, but inflation levels also is www.xe.com/currency. Okay, check that out if you get a chance, right? And so if you go to that website and you click on CAD, CAD for Canadian dollars, we can see that the inflation rate in Canada is 1.6%, which means prices rise by about 1.6% every single year in Canada. Okay, and just above that figure here, we can see the exchange rate for Canadian dollars in other major currencies. Okay, and we can see here that 1 Canadian dollar buys 73 US cents, or 1 US dollar buys $1.37 Canadian. Okay, and we can also see that the nickname for the Canadian dollar is the loonie, as the loon is on our Canadian $1 coin. Okay, let's move on. We also see that the interest rate in Canada, which is called the central bank rate, is 0.5%, very low. Okay, and we can also link to the Bank of Canada from this website here. Okay, you see it here, which is the source of the interest rate and inflation statistics here. Okay, let's go back to xe.com's website, and we can see charts of the historical moves in currencies here. And if the company that we are investing in does a lot of business in other countries, we really need to know what the currency exchange rates are, or else we might not be able to calculate the correct earnings estimates if the company does not hedge out or cancel the exchange rate differential with financial products. Remember, I talked about Southwest hedging out the price of oil, right? Companies can do the same thing with exchange rates, okay? And again, we'll cover hedging later in more details. Okay, so economies that are more dependent than others on selling commodities or other natural resources like oil include Canada, Australia, and Brazil. As such, most of the time, when oil prices are very high, so too are the three currencies relative to other currencies. Okay, why is that the case? Why is it the case that the Canadian dollar, the Australian dollar, and the Brazilian real go up a lot when the price of oil goes up? Okay, well, this example explains why. If the price of most major commodities are very high, then if China wants to build a lot of iron ore, or buy a lot, I should say, of iron ore from Australia to make steel, then China would have to buy more Australian dollars, okay, in order to buy Australian iron ore, which drives the price of the Australian dollar up, okay? And the same thing can be said if China wants to buy more oil from Canada. Canada has a lot of oil, heavy oil, that's only profitable if the price of oil is very high because it's very expensive to extract that, okay? And so in terms of Australia with iron ore, the converse, of course, holds true, okay? When most commodity prices are dropping, then when China needs to exchange money to buy those commodities, it can exchange less money for fewer Australian dollars in order to buy Australian commodities, okay? And if China decided all of a sudden, this is not going to happen, but if they decided to stop construction for a long period of time, right, then you'd see the price of commodities going down a lot, which would mean the price of the currencies for natural resource-rich countries like Australia, Brazil, and Canada would go down a lot. And this happened a little bit in 2008. So what China did was they had the Olympics in 2008, and it was an incredible success. It was amazing. But what the Chinese government did was 3 months before the Beijing Olympics in 2008, the Chinese government shut down all industrial production within the 300-mile or so radius around Beijing, so that when the whole world arrived, it would look like there wasn't pollution or as much pollution there. And that actually had an impact, right? That's one of the reasons why there was a bit of a commodity hit, right, that happened in 2008. Of course, there's other reasons as well. I digress. Okay. I also like to look to use this website for looking at historical exchange rates. Okay, it's called www.forexfactory.com, and this website is incredibly detailed. Okay, so if we look at the historical chart of the Canadian dollar relative to the US dollar, we see that the Canadian dollar was at par with the US dollar, meaning that both were valued at $1 each relative to each other in 2008. Why? Because at that point in 2008, the price of oil was over $100. Okay, so far we have discussed currencies that are what are called floating currencies, meaning currencies that increase or decrease relative to other currencies, right, based on supply and demand. Okay, now governments that do a lot of business, right, with one or a few larger countries, what they do is they actually fix or peg their currency to another one, so that the value of their currency never changes relative to the larger country's currency, okay? And the way that these countries maintain their fixed or pegged currency is through massive open market purchases or sales of their own currency, right? Through that country's reserves, right, of foreign currency. Okay, so stick with me here. So when demand is too high for their own currency, these governments will buy bonds, right? Which basically the government gets bonds, and in return they give others money. And what happens is there's more supply of money out there, right? And so the what happens is the rate of their money, right, the FX rate, goes down or stays fixed, right, to that economy that they want to have their currency rate fixed at. Now, the only way that you can maintain your currency fixed at a price relative to another currency is if you have a lot of reserves, right, a big stockpile of money, okay, so you can buy and sell, okay? And recall that the higher the supply of a currency, the lower the interest rate is for that currency, okay? And this is artificial, and it can be manipulated for many, many years by countries, right? As long as their underlying currency reserves are plentiful, right? I know what you're thinking now. What happens if they run out, okay? Well, I'm going to talk about, this is controversial, but, and a lot of people won't appreciate me bringing this up, but I have to. George Soros, right? He's the most successful currency or macro trader in history, right? And he's made billions of dollars, right, by breaking countries' currencies, right, which can have, a traumatic impact, okay? So he's made billions of dollars, including $1 billion in one day, by forcing governments, right, to make their fixed or pegged currency change to floating. He forced them to do it. How did he do it? Well, he did this to the Bank of England, and he also did this to the Thai baht, right? And how did he break the Bank of England and the Bank of Thailand? How did he force them to get rid of their fixed exchange rate and make it variable, make it float? Okay. And what he did was he bet against those currencies. So when the governments were forced to float them, right, the currencies dropped a lot and he made a fortune. Okay. And that's called shorting. Again, we'll talk about that in more detail later. But I want to, kind of put it on your radar screen a little bit more so now. Okay. So in terms of the Thai baht, in the mid to late 1990s, there was this awful Asian crisis. That people call it the Asian flu at the time. And people speculate that Soros helped make it much worse. And so the economy in Thailand then was not doing that well. And the government in Thailand wanted to maintain their fixed currency status, right? And demand for the Thai baht was down a bunch because of the crisis in Asia, right? The crisis that Asian countries had at that time. Okay, and so in order to maintain the current fixed exchange rate, the government of Thailand purchased a lot of their own currency, okay, the Thai baht with US dollars, right? Therefore, artificially keeping demand high for the Thai baht, which kept the exchange rate of the Thai baht fixed to the US dollar. Okay, now, since there were fewer bahts out there from a supply perspective, the government of Thailand was able to keep the fixed value of the baht at a fixed price relative to the US dollars. Okay, and so at that point, the government of Thailand had about $37 billion in US dollar reserves, right? So that they could, keep that fixed rate. Soros pressed his short bet on the Thai baht, right? And other hedge funds joined him, right? They smelled blood in the water, right? It happens. They call it the hedge fund mafia. They all jump on it together, right? And this happens with a lot of stocks too that get shorted, right? It's tragic, right? So this assault or drive-by assault occurred. More hedge funds jumped on it. They sensed blood in the water, including a very famous hedge fund called Tiger, right? That had a $3 billion bet against baht, right? And eventually, the government of Thailand ran out of their U.S. dollar foreign reserves, right? And they couldn't prop up the baht relative to the U.S. dollar, right? And so they had to let the free market take over, right? And float the Thai baht, right? And George Soros and other hedge funds made an absolute fortune, offshoring the Thai baht, which went down a lot after the government ran out of foreign reserves and had to let the Thai baht float, which meant it went down a lot, okay? And George Soros did the same thing kind of with the Bank of England, right? And he made a lot of profit in 1992 on what traders call Black Wednesday, okay? And although he broke the British pound currency peg, he did far less damage to the British economy than he did to economies in Southeast Asia in general. Okay, and so at that time, though, in 1992, the British pound was pegged to the German Deutschmark. And in the early 1990s, Germany had to raise interest rates a bunch in order to keep inflation low, right? And they had growing pains as well because of the unification of East and West Germany, okay? And also at that time, the U.S. economy was not doing that well, okay? Which really hurt the UK, as the UK did a lot of business with the United States as a trading partner, okay? And so the British government ran out of reserves, right? And George Soros' massive short position caused the Bank of England to let the pound float. And George Soros made $1 billion that day as the pound dropped about 10% that day. And Soros profited from his short position in the pound. Okay. And so we know that shorting an investment basically means you make money if it goes down. So it's basically the opposite of buying a stock or buying an investment. And so the following countries have their currencies pegged to the US dollar or other relatively stable and strong economies, right? As these countries might do a lot of business with the United States or these other countries. And hence, rather than dealing with the uncertainty with FX or foreign exchange swings, these currencies remain fixed at the same level or same price, right, to the United States dollar, okay, or the other currencies until someone like a George Soros might potentially one day, force them to change this policy, okay? So we know that high inflation leads to higher interest rates. And I think it's really important to discuss great economic entities or events that are somewhat deflationary, right? And you really have to look for long-term economic trends, right? And so I'll give you a couple of examples. Walmart had a big impact on deflation in the United States, right? Prices were kept in check because Walmart basically offered everything, sold everything for next to nothing, right? And the same thing can be said for Amazon now. I think Amazon actually is keeping inflation in check in America right now, right? And in many countries too. And Amazon has something called Amazon Web Services, which basically is the infrastructure, software infrastructure that every massive, high-growing internet company runs on now, right? So for the most part, like Uber, for example, and Netflix and Airbnb, they run off of Amazon Web Services. And Amazon keeps cutting that pricing point a lot. And so when I think of Amazon Web Services today, I think it's incredibly deflationary to the same extent that the Berlin Wall was, back in the late 80s, early 90s. When Reagan had that epic speech, I'm getting shivers just thinking of it, saying, when he said, "Mr. Gorbachev, tear down that wall." What happened was you had all this brilliant Eastern European cheaper labor move west, right? And the biggest input price into producing most products is labor, right? And so the price of labor stayed low for a while, and that's why we had unprecedented economic growth back in the 1990s.